Before a bank lends $1 million or an investor buys a single share, they need to know if the company is actually financially healthy. But there is an inherent conflict of interest at play. The people managing the company have a clear incentive to make their business look as successful and profitable as possible. The outside investors, meanwhile, require the unvarnished reality. If buyers and sellers cannot trust the numbers they are given, the entire system of capital allocation grinds to a halt. Broad financial markets only function efficiently when reliable, accurate information circulates freely. Without an objective way to verify the math, corporate financial reporting is practically indistinguishable from a marketing brochure. To solve this problem, the accounting profession provides a service known as assurance. It is an independent, professional review designed specifically to bridge the trust gap between management and external users. By stepping in as a neutral third party, practitioners can catch accidental errors, reduce the risk of management bias, and ensure that the information flowing into the market is actually of high quality. Assurance is the mathematical process of taking questionable corporate claims and stress testing them until they become credible market data. This 5-node radial chart maps out the strict anatomy of an official assurance engagement. Every valid review is built on these exact 5 interconnected components. First is 3-party involvement. You need the responsible party, which is usually the company's management, the practitioner, who is the independent accountant, and the intended user, like a shareholder or bank. Next, you need a subject matter, the raw data being checked, like a cash flow forecast. You also need criteria. These are the formal rules, such as international financial reporting standards, used to accurately judge that subject matter. The practitioner then gathers sufficient, appropriate evidence to verify the numbers, and finally issues a written report detailing their conclusion. Whether a firm is evaluating a local startup's business plan or a multinational corporation's sustainability report, every assurance engagement requires these 5 structural pillars. This horizontal spectrum shows that assurance is not a binary state. The International Federation of Accountants scales assurance across different levels of confidence. On the lower end is limited assurance. This provides a moderate level of certainty. Because the accountant performs fewer tests, they issue a negative conclusion, meaning they state that nothing came to their attention to suggest the data is materially misstated. On the high end is reasonable assurance. Here, the practitioner gathers extensive evidence to issue a positive expression of opinion. They are actively verifying that the information is prepared correctly. This spectrum dictates exactly how much weight stakeholders can safely place on an accountant's final report. The most rigorous and recognizable example of a reasonable assurance engagement is the financial audit. While many assurance reviews are voluntary, statutory audits are legally mandated by governments to protect minority shareholders and external providers of finance from corporate mismanagement. The specific objective of an audit is to gather enough evidence to state whether a company's historical financial statements give a true and fair view of its economic reality. An audit is separated from generic assurance by its heavy legal weight, its rigorous evidence requirements, and its strict focus on historical financial accuracy. These diverging trend lines map out a problem known as the expectations gap. It is the dangerous misunderstanding between what the public thinks an auditor does and what the legal standards actually require. No assurance engagement, not even a statutory audit, can ever provide absolute 100% certainty. Auditors cannot physically check every single transaction, so they test a sample. This means there is always a statistical risk that a misstatement slips through. Furthermore, while auditors assess systems for material errors, it is the company's management, not the auditor, who is responsible for designing internal controls to prevent and detect fraud. Treating an audit report as a foolproof shield against all corporate error creates severe vulnerabilities for investors who misread the fine print. The defined spectrum of assurance gives capital markets a standardized way to communicate exactly how reliable corporate data really is. Understanding the precise boundaries of audit and assurance provides the fundamental vocabulary for navigating trust in the global economy.